Latest results from our Delivering Alpha Investor Survey brings together the market intelligence of the nation's leading institutional investors, top strategists, and our own CNBC contributors. We asked them what the top performing areas in the U.S. would be next year, and they responded by highlighting financial stocks, high dividend stocks, healthcare stocks, and of course, mega cap tech. Joining us for more on the markets, Greg Branch, Veritas Financial Group managing partner and a CNBC contributor. Greg, thank you. I want to get into those survey results in just a second, but kind of if we could start broad, in looking ahead to 2024. In the producer notes, you admit that you were wrong in 2023 and that the cycle didn't play out exactly as you expected, which I think is kind of conventional wisdom, although I don't know if everybody would actually admit that. But you are saying, as you look ahead to Q1 24, that you think it will play out actually a lot like Q1 22 with a sharp correction. Why is that?
Well, Leslie, the question becomes, is it that it didn't play out and it won't, or that it didn't play out yet? And I think it's the latter. I don't think it's the former. And so normally when we see the Fed raise like this, what we see is a dearth in credit growth, and we saw that. But we didn't see businesses stop spending, and we didn't see consumers stop spending. And I think it's important to identify the reasons why. Number one, we had a substantial growth in private credit. Number two, the cash to asset ratio of the S&P 500 is at or near historical highs. And so businesses had a lot of runway from the savings from the pandemic. Businesses had a lot of runway and consumers had a lot of runway from the stimulative actions we saw in 2023. But that runway is limited. And so I think that we will see the cycle play out. It's just that the duration between the dearth of credit growth and the spending is much more elongated than we've seen historically. And I think we're starting to see that on the margins with small businesses.
What limits that runway? Because you look at the Goldman Sachs financial conditions, currently they're at easier levels than they were even back in 2022. And then if the Fed ultimately does pivot, as the swaps market would indicate, that's also potentially decent news for stocks as well. So what is it that you think could really get in the way? What are the obstacles that you see kind of derailing the directionality of the market right now?
I think you said the key word, Leslie, and that's the Fed. I think much like I predicted in 2021, we'll see a difference between the Fed's posture and what they're forced to do. The economy is growing at 5%. Unemployment's at 3.7%. The NIFB survey indicates that businesses continue or expect to continue to hire. And so I think the Fed has a problem, particularly with what they told us last week. I think the Fed's problem is that there's really no visible way to get from 4% to 2% as long as unemployment remains where it is, and as long as the indications for services inflation remain rather strong. Remember, core bounced back into that 30 to 40 basis points month over month rise last month. I know we all celebrated the 20, and we thought that that would be a new paradigm, but it wasn't. And so while I know this is going to be controversial, I think it's more likely that we see a hike in the first quarter than we see a cut. And that will harshen the environment.
But so you're not convinced, or you're not, at least you don't see it as being optimistic that, at least the recent core PCE figure came in on a 6-month basis below that 2% target. You don't think that it can achieve that on an annualized basis?
Well, we had the same debate 2 months ago, Leslie, right? When the jobs number went to 150, when core went to 20, it's that we need a consistent set of data, not just one data point. And so that in that PCE report, I think that things other than services did a lot of heavy lifting, and I think we'll see. But I think that the Fed's hand is going to be forced here because I just don't see how inflation in and of itself, with unemployment at 3.7% and jobless claims at historical lows, is going to get to the level where we're going to have some headwinds on that services inflation.
So let's go back to those survey results if we can. So the top performing areas in the U.S. next year, the survey answerees said financial stocks, high dividend stocks, and healthcare stocks. Presumably, given your thesis about the state of the macro in 2024, would indicate you disagree with these prognostications.
I agree, actually, to some extent. Let's take the utilities first. If you believe that we will be in an interest rate cutting environment, then those income streams become more valuable. And utilities haven't participated. Their forward multiple is about 15 times compared to the S&P's 19.6 times. They're down on the year when you look at the ETFs. And so that's an area I'd take a look at, particularly if you think this rally is going to broaden. And I think it will over the next couple of months, because there's no identifiable near-term catalyst for the correction I see coming.
Yeah, well,
Financials, same thing.